So for this session, our topic will be cash and cash equivalents. Now, for cash and cash equivalents, what we need to learn is, of course, the recognition of your cash. After your recognition, we have your measurement of your cash. And lastly, your presentation of the items of your cash. Our main issue normally for cash and cash equivalents is the presentation, whether they are included as part of cash and cash equivalents or they are excluded as part of our cash and cash equivalents. So later on, as we go through our discussion for cash and cash equivalents, you will learn when will we include or exclude an item of cash and cash equivalents. So let's start now by defining what is cash. So what is cash? Cash is defined as money and other negotiable instruments. Money and other negotiable instruments that is readily available for deposit and immediate credit. Okay? So we define cash as money and other negotiable instruments that is payable in money or that is readily available for deposit and immediate credit. Therefore, whenever we talk about cash, it is composed of two items. The first item is money, and the second item is known as your negotiable instrument. Now, for money, this is defined as your coins and currencies. For negotiable instruments, this is defined as those payable in money and acceptable by bank. Okay, anything that is payable in money. But what is the requisite so that we can say it is an item of cash? We said it is a cash if ever it is readily available for deposit and immediate credit. Therefore, we can say that the money or negotiable instrument is part of cash if ever it met this requisite. And what is that requisite? The requisite is that it is readily available for deposit and immediate credit. Okay? Therefore, whenever we define cash, cash is defined as money and other negotiable instrument that is readily available for deposit and immediate credit. You look into whether that money or negotiable instrument is really readily available for deposit and immediate credit. Now, if this is met, then it is part of cash and cash equivalent. But if that is not met, then it is not part of cash and cash equivalent. Now, let's start first with your money. So whenever we talk about money, we said these are your coins and currencies. So generally, whenever you have coins and currencies, these coins or currencies can either be on hand or in bank. On hand or in bank. If that money is on hand, then no problem. That can be a foreign currency, right? That can be a foreign currency such as yen or dollars, or it can be a local currency. As long as that foreign currency or local currency is readily available for deposit and immediate credit, then it is considered money. However, for cash in bank, it must be, again, readily available for deposit and immediate credit. So what do we mean really for readily available for immediate credit? It means that it is unrestricted. It means that it is unrestricted. Therefore, whenever we talk about cash on hand and cash in bank, what we test is that it must be unrestricted. Because once it is restricted, then it is not part of cash and cash equivalent. So your main issue for your cash on hand is whether it is considered restricted or unrestricted. For in-bank, again, still whether it is restricted or unrestricted. Now, let's look into your cash in bank. As a rule, if ever it is restricted, then it is not part of cash. Okay? If that is restricted, it is not part of cash. So when can we say that it is considered restricted? It is restricted if ever it is for non-current use. Then how do we present it? Sabi natin, di ba? Pag restricted yung cash in bank natin or cash on hand natin, hindi siya cash. So pag non-current use yan, how do we present then our cash? We present it as a separate line item, normally as part of non-current assets. So separate line item, part of non-current asset. Now, what if it is restricted, but in the form of a compensating balance? In the form of compensating balance. Now, what is a compensating balance? A compensating balance is the amount that is required by your bank to be kept on your account. It is the amount that is kept in your bank as the minimum amount. So what will we do then in your compensating balance? For compensating balance, you need to look whether it is legally restricted as to withdrawal or not legally restricted as to withdrawal. If it is legally restricted as to withdrawal, it is part of your separate line item, current asset. But if it is not legally restricted, it is part of cash. It is part of cash. Okay? So our first issue, again, our first issue for your cash is whether it is readily available for deposit and immediate credit. So we said, once it is readily available for deposit and immediate credit, it means it is unrestricted. Once it is unrestricted, it can be part of your cash and cash equivalents. Therefore, our main issue is, when is it restricted? It is restricted, it means that it is not part of cash. So when it is restricted, it means it is for non-current use. Then it is a separate line item. Next, for compensating balance, we need to look again whether there is a legal restriction. When it is a legal restriction, it is a separate line item again. It will be part of your current asset. But if it is not legally restricted, then it is cash. That is for your money. Now, we look into the issues as to your cash in bank. So what are your issues as to your cash in bank? So the first issue in your cash in bank is known as your closed bank. First issue in your cash in bank is known as your closed bank. What happens in a closed bank? So whenever the cash is in a closed bank, it means that it is not already part of cash. It is not already part of cash. Why? Because it will become a receivable. Therefore, whenever you have a cash in bank in a closed bank, not part of cash, it will be part of your receivable. Maybe your question is whether it is current or non-current. It is considered current if ever it is collectible within 1 year, but it is considered non-current if collectible for more than 1 year. So what is a closed bank again? Whenever you have a cash in bank in a financial institution which is having a financial difficulty or a bankruptcy, then it is considered as a closed bank. If it's a closed bank, it is not part of cash, but it is a receivable. And how do you present it? You present it as current if it is collectible within 1 year. You present it as non-current if it is collectible for more than 1 year. Furthermore, how do we measure this receivable? You measure it at its estimated realizable value. Estimated realizable value, or also known as the NRV. So you will measure the amount or the cash in your closed bank at its NRV, or also known as your recoverable value. Okay, that's our first issue. Next issue on your cash in bank is your bank overdraft. So in your bank overdraft, for bank overdraft, just remember it is not part of cash. As a general rule, it is not part of cash. What is our treatment? It is to be treated as a liability. It is a current liability. It is a current liability. When is there a bank overdraft again? We say that there is a bank overdraft if ever the amount of your debits in your cash in bank is greater than your credits. If the debits in your bank is greater than your credits, then you have a bank overdraft. As a rule, again, it is considered as a liability presented as current. However, what is the exception to the rule? Wherein it is part of your cash. It is part of your cash if ever you can offset it into your bank account. You can offset it to your bank account with the same bank, or the amount is immaterial. Okay. So on our second issue in your bank overdraft, if ever there is a negative balance in the bank account, how do we treat it? We treat it as not part of your cash. So we treat it as a liability. It will be part of your current liability. However, if any of these two is item, if ever you can offset it to your bank account within the same bank, or the amount is immaterial, then you can remove it as part of your cash. Okay? So it means that you can offset it. Let's have an example on your bank overdraft. Let's assume you have here PNB 300,000. And then we have here your BPI current negative 100,000. And then you have here BDO 10 million. Assuming it is immaterial, assuming the overdraft is material, how do you present this one? How do you present the BPI current? It will be part of your current liability. Therefore, what is the amount of your cash? Your cash will be the PNB and the BDO. That is 10.3 million. Now, assuming we have here PNB, 300,000. You have here BPI current, which is negative 100,000. And then you have here again BPI amounting to 1 million and BDO amounting to 10 million. So we said, once there is a bank overdraft, it will be a liability. But if ever it is on the same bank, you can offset it. Therefore, we can offset the BPI current to another BPI account. You have now 900,000 for BPI. So our total will be equal to 11.2 million. So again, for a bank overdraft, just remember the treatment is that you can offset it to the same bank. Or you can also offset it if ever it is immaterial. But as a general rule, if ever the two items are not present, any of the two items are not present, then it will be treated as current liability. And the last issue here is the compensating balance. The last issue is the compensating balance. For compensating balance, what did we say? If ever it is legally restricted, then it is not part of your cash. But if it is not legally restricted, then it is part of your cash. Okay. So before we proceed further regarding cash and cash equivalents, let's recap what we have already discussed. So we're talking about cash as money or negotiable instrument. And this money or negotiable instrument must be readily available for immediate credit. When we say readily available, it is unrestricted. So what is the general rule there? The general rule is that once it is considered restricted, it is not cash. Once it is considered restricted, it is not cash. And what are the forms of restrictions? The form of your restrictions is that whenever it is for non-current use, whenever it is for non-current use, then it is considered restricted. That's our first premise. And after that, we went on and discussed the first portion of your cash, which is your money. And we said your money is composed of two items. That is your cash in cash on hand, and then we have here your cash in bank. For cash on hand, you don't have any problem. Why? Because these are your foreign currencies or your local currencies. For cash in bank, you have a problem if ever any of the issues here are present. What is the first issue that we have discussed regarding cash in bank? That is known as your It is known as your okay. Let's start first with bank overdraft then. I forgot your mics are all off. I was waiting for a recitation anyway. So bank overdraft. We start with bank overdraft. So the first issue is your bank overdraft. As a general rule, your bank overdraft is not cash. Our treatment is that it is a current liability. What is the exception to the rule? First, if there is a same bank, of course, the same bank must have a positive balance. And second, it is immaterial. So if ever it is the same bank with positive balance or it is immaterial, then you can offset it. You can offset it. Second one, we have your closed bank. So in a closed bank, the general rule here is that, again, the rule only, it is a general rule. The rule only is that it is not cash. It is part of your non-current asset or a current asset in the form of your receivable. So what is the measurement of your cash in bank in a closed bank? We measure it at your recoverable value or NRV, recoverable value or NRV. Then as to whether it is current or non-current, then it depends whether you can collect it within 1 year or not within 1 year. That's for closed bank. And then lastly, we have your compensating balance. For compensating balance, we will only look whether there is a legal restriction. If your answer here is yes, then it is treated as not cash. If there is no legal restriction, then it is part of your cash. Okay. So far, these are the things that we'll already discuss. So we're done in your money. Take note, for determining whether it is cash or not cash, just always remember that it is unrestricted. Once you see it is restricted, then you do not place it as part of your cash. And furthermore, if the problem is silent, compensating balance, compensating balance is always for non-current use. Therefore, it is considered as restricted. Okay? Not current use, it is considered restricted. For bank overdraft, always remember, you check whether the problem will say it is immaterial or material. Okay? If ever the problem is silent, it is best that you treat it as material. You treat it as material. Do not always treat it as immaterial. The general rule is you treat it as immaterial. Normally, questions here in your cash in bank as to your bank overdraft, it focuses on your same bank with positive balance. As to compensating balance, you look into your legal restriction. But once you master the different rules here, then it is easy to classify the money or the cash in hand and cash in bank. Okay? So we're done on the first part, that is your money. On the second part, it is now your negotiable instrument. Okay, so the next item of your cash is, okay, we're done on your first part. It is your money. Then you go now to your negotiable instrument. What is the test again for negotiable instrument? The test for negotiable instrument again is that you look whether it is readily available for unrestricted use. In short, it must be unrestricted. And whenever we talk about negotiable instruments, we have only one negotiable instrument that can be classified as cash. Why? Whenever we talk about negotiable instrument, it must be payable in money and acceptable by bank. And one item only satisfy this definition. That is your checks. So these are your checks. So for checks, how do we account for your checks? So as a rule, if you have received a check, then it is part of your cash. Once you receive a check, it is part of your cash. However, always remember that in your checks, it could have been a check that you are the issuer or a check which you are the receiver. So it can be a check in which you are the issuer or a check which you are the receiver. So whenever you are the issuer, you use that as payment. If you are the receiver, you use it, of course, as a receive. So in issuer, this is normally a decrease in your cash, while your receiver, you have an increase in cash. For negotiable instruments, our main issue here are the different items of check. So what are your issues relating to check? So the first issue as to your check is known as your unreleased check. So what is an unreleased check? An unreleased check is a check in which you are to pay or to issue, however, you did not release it. Okay? You did not release it, or you did not give it to the payee. So since it is unreleased check, as a general rule, whenever you issue a check, what is the effect? It decreases the cash, right? So what is then your adjustment whenever it is an unreleased check? If it is an unreleased check, it must increase your cash and it will decrease your accounts payable. Take note, as a rule, the entry whenever you issue or you have a payment in the form of check, the main entry is a debit to AP and a credit to cash. That's why it decreases cash. Now you have an unreleased check. Initially, at the point you have the check, you entered AP and cash. However, as we said, you did not release it. Therefore, there is no movement of your cash. So you increase your cash and you decrease your AP. How about for the receiver? Is there an entry for the receiver? As a general rule, there is no entry on the part of your receiver. Why? Because the check is unreleased. In short, the receiver does not have any idea that the check was already written. Unless it has an idea, then you can make an entry or adjustment. But as a rule, there is no adjustment of unreleased check on the part of the receiver because it did not receive yet that check. It did not receive yet the check. So no receipt yet of check. Since no receipt of check, then you do not need to make any adjustment. Second issue regarding your check is your stale check. So what is a stale check? A stale check is known as your expired check. Under the legal parlance, we can say that the check is stale whenever the check is not encashed within 6 months from its issuance. So from the date of issuance, then we need to look whether there is already a 6-month period. On that 6-month period, once it is expired, then it is considered a stale check. So for the stale check, whenever the check is already stale, your entry on the part of the issuer is again an increase in your cash and also an increase on your AP. Increase on your cash and increase in your AP. How about on the receiver? If you receive a stale check, you need to decrease your cash and you increase your AR. Sir, why do we need to decrease your cash and increase your AR? Because the general entry whenever you receive a check is a debit to cash and a credit to AR. However, when you receive the check, what happens? It is already expired. Therefore, you cannot make use of that cash. Since you cannot make use of that cash, you need to decrease the cash and increase the AR. You need to decrease the cash and increase AR. Third issue on your check is your post-dated check. So what is a post-dated check? It is a check dated on a future date. Okay, it is a check dated on a future date. So in short, let's say today is June 21. You receive a check which is dated, let's say, July 15. So as of June 21, do you have the right to use unrestrictedly that cash? No, you don't have the right. Since you don't have the right, then it means it is not part of your cash. So what then is the adjustment? You need again to increase your cash and to increase your AP. For the issuer. For the receiver, again, you need to decrease the cash and you increase your AR. That's for post-dated check. And lastly, we have your NSF check. What is an NSF check? Known as your no sufficient fund check, no sufficient fund, or also known as your drawn against insufficient fund. So if that is an NSF or drawn against insufficient funds, then it is not part of cash. Why is it not part of cash? Because here, on the part of the receiver, you receive a check na wala namang laman. So since wala namang laman, yung mismong bangko, it means, or yung bank account nung nabigay ng check sa'yo, it means that hindi mo yun pera. Since hindi mo siya pera, you need again to decrease your cash and increase your AR. How about on the part of the issuer? Considered ba na bayad yung NSF check? Siyempre hindi siya considered na bayad. Bakit hindi siya considered na bayad? Wala kang laman eh. So hindi ka nakapagbayad talaga. So since hindi ka nakapagbayad, anong gagawin natin? Increase din natin yung cash natin kasi initially binawasan mo siya and taasan mo rin uli yung liability mo in the form of accounts payable. Okay? So those are your issues for your check. So remember, for negotiable instrument, we are only talking about your checks. So generally, what you need to learn here are the different treatments as to the different items of check. So for unreleased check, you need to determine whether you are the issuer or the receiver. For stale check, post-dated check, and NSF check, just remember the effects as to our cash and as to the items of your AP or AR, depending whether you are the issuer or the receiver. That's for your negotiable instrument. Okay, so what are the items again that we need to remember for cash? For cash, that is either money or negotiable instrument. For money, that is either cash on hand or cash in bank. For cash in bank, just remember for the 3 items. First, we have your closed bank. Next, you need to remember, aside from your closed bank, you have your aside from your closed bank, you have your compensating balance. Okay, sorry, compensating balance. And then last one, we have your bank overdraft. Very good. For negotiable instrument, we are talking here about your checks. So what are the items that you need to remember? First, we have your stale check. Aside from your stale check, we have your unreleased check. Aside from unreleased check, we have the so-called post-dated check. And then we have your NSF check. If in case there is this so-called antedated check, what is this antedated check? This is a check that is dated even before you receive it. If post-dated is dated after you receive it, therefore it is not part of cash. For antedated check, as long as you receive it, it is already part of your cash. As long as you receive it, part of cash. As long as you use it as payment, it is already removed as part of your cash. So just remember, for if in case may kabaliktaran ng post-dated, which is known as antedated. In short, it is dated before you receive it. Kabaliktaran nun yung post-dated. Pagka ni-receive mo na agad yun, cash na siya. Pagka in-issue mo na siya as payment, then hindi na siya cash. Okay? So that's your cash. That's your cash.